All right, so uh, we're going to be diving into the world of cat bonds and not the furry kind,
Right.
type catastrophe bonds and, how they've been performing this year.
Yeah.
And you sent over some really interesting articles. We're going to focus on a piece called Springing Ahead, Analyzing Cat Bond Returns for 2024.
Yeah, that's a good one. It really gets into the nitty-gritty of what's been driving returns this year. And trust me, there have been some surprises this year.
Oh, I love surprises.
Yeah.
So where do we even begin to unpack this?
Well, think of cat bond returns like a three-legged stool.
Okay.
You've got price return, collateral return, and then the return from that floating coupon spread. And each one plays a crucial role.
Okay, I'm visualizing this stool in my head.
Yeah.
So let's break down each leg. What's price return?
So price return, it's basically how the bond's market value fluctuates. Think back to last year, we saw a nice price bump thanks to the market recovering after Hurricane Ian. This year has been a bit more modest in comparison.
Yeah, that makes sense.
Yeah.
So what about that second leg, collateral return?
That's your steady Eddie, the reliable one. Your principal is invested typically in something like money market funds, which provides a consistent return. It's the foundation of your overall return.
Gotcha. So it's like a safety net built in.
Exactly.
All right, and last but not least, that third leg, that floating coupon spread. That sounds a little more unpredictable.
Ah, yes. This is where things get interesting. You see those higher yields we saw on new cat bonds issued in late 2022 and early 2023. Those are playing a big part in keeping the overall returns healthy this year. But that floating spread can also be volatile.
Okay, so we've got price return, our potential for growth, collateral return, our steady base, and the floating coupon spread, which can really swing things up or down. Now, you mentioned some surprises. Springing Ahead talks about a roller coaster ride in Q2. What happened?
Well, in the spring of 2024, yield spreads suddenly jumped. It was a real departure from what we saw in the first quarter, and it even impacted brand new bonds that were issued during that time.
Whoa, so even the new bonds were affected. That's wild. What
Yeah.
caused that sudden shift?
Well, there are a few possible culprits. Around April and May, there were widespread predictions of a very active hurricane season, which may have spooked some investors, leading them to sell off their wind-exposed bonds. This selling pressure would have driven prices down and spreads up.
So market sentiment, fear of a busy hurricane season that played a role. Was there anything else at play?
Yeah, the timing's interesting because the spread jump also coincided with the release of an updated hurricane risk model from Moody's RMS, and this model significantly increased the perceived risk for certain areas, causing a reevaluation of some bonds.
So we've got jitters about hurricane season and a new risk model shaking things up. Anything else?
It's also possible that some ILS fund managers were freeing up capital to invest in private ILS markets leading into the June reinsurance renewals.
Okay, so a combination of factors, forecasts, risk models, and even strategic moves by fund managers. It sounds like a pretty complex situation.
It certainly was. And this brings us to another important concept: price adequacy.
Okay, price adequacy. What does that even mean in the context of cat bonds?
It's all about value for risk. It's essentially asking, are the coupon spreads, the return you're getting justified given the expected losses the risk you're taking?
So are we getting bang for our buck with these cat bonds?
The good news is that broadly speaking, things look pretty good. Cat bonds issued in 2023 and 2024 have generally shown a better return relative to the risk compared to previous years. But with that spring surprise, it's important to look closely at price adequacy trends, especially for those newer bonds.
It makes you wonder if those higher spreads in Q2 are a blip or a sign of a bigger trend.
Exactly. And that's what makes this so fascinating. There's a lot of uncertainty. And it raises some crucial questions about how we evaluate these investments going forward.
All right, so we've got these three factors driving cat bond returns,
Yeah.
price collateral, and those potentially volatile floating coupon spreads. Then Q2 throws us this curveball, the spring surprise, which has us all wondering about price adequacy. This is a lot to unpack. What really stood out to you from Springing Ahead?
What I found really interesting is how the article breaks down price adequacy trends by quarter. You can see the stark difference in Q2, how those spreads jump up. It highlights that while overall price adequacy seems okay, the story is more nuanced than that. And it raises a question: was that spring jump a temporary reaction, or is it the start of a new normal?
That's a great question, and I have a feeling the answer could have a big impact on how we approach cat bond investments moving forward.
Yeah, it could definitely have a ripple effect. Think about it: if those higher spreads in Q2 represent a fundamental shift in the market, it could impact the entire cat bond landscape, even those indices that track the overall market performance.
Right, because those indices are reflecting the performance of all these individual bonds.
Yeah.
So a shift in pricing would show up there too.
Precisely. And this is where diving deeper into price adequacy trends by quarter becomes even more crucial. The Springing Ahead article highlights how new cat bonds issued in Q2 had a noticeably higher price per unit of risk compared to those issued in Q1.
So even with all that uncertainty swirling around, investors are demanding a greater return for the risks they were taking on with those new bonds.
Exactly. And you know what else stood out to me? The article's point about the uncertainty surrounding those pricing models. It suggests that simply relying on expected loss calculations might not be enough to grasp the complexity of what's driving cat bond prices.
Okay, so there's more to the story than just crunching the numbers on expected losses.
Yeah.
What other factors are at play?
Well, we've already touched on how those forecasts for an active hurricane season and the release of that updated risk model, they influenced investor behavior, which in turn affected bond pricing. Those aren't always directly reflected in those expected loss calculations.
Right. I'm starting to see the bigger picture here. It's not just about the numbers, it's about how investors are feeling, how they're perceiving those risks.
Exactly. It suggests that we need more sophisticated models that can account for those less tangible but incredibly important factors, like market sentiment and investor perception.
So we need models that can capture not only the hard data, but also the emotional side of investing.
Precisely. It's fascinating, isn't it? And this leads to another critical point, the relationship between price adequacy and the flow of new capital into the cat bond market.
Right. You mentioned earlier how strong investor appetite for cat bonds played a role in pushing up yields in late 2022 and early 2023. How did that tie into price adequacy in 2024?
Well, it creates this interesting push and pull dynamic. On one hand, you have investors who are drawn to cat bonds for their potential to generate higher returns, especially compared to those low yields in traditional fixed income investments. This strong demand can drive up prices and compress spreads, which can lead to situations where price adequacy becomes a concern.
So, too much enthusiasm could actually lead to investors accepting lower returns for the risk they're taking.
Yeah, it's almost counterintuitive. But then on the other hand, you have those external factors that can create an opposing force. Things like those concerns about an active hurricane season, the new risk models, and even the strategic moves of those ILS fund managers. These can push spreads wider, potentially improving price adequacy.
So it's like this delicate balancing act between investor demand and these external factors.
That's a great way to put it. And understanding this dynamic is absolutely crucial for navigating the cat bond market effectively. It highlights that price adequacy isn't static. It's constantly influenced by this complex interplay of quantitative and qualitative factors.
Yeah, it really makes you realize there's a lot more going on beneath the surface of these cat bond investments. We've talked about returns, pricing those Q2 shakeups, but these bonds serve a much larger purpose, don't they?
Absolutely. At the end of the day, cat bonds play a crucial role in how we finance disaster risk. They provide a way for insurers and governments to transfer risk, freeing up capital that can be used for things like disaster preparedness and recovery.
That's such an important point. It's easy to get caught up in the financial side of things, but ultimately these instruments have the potential to make a real difference when those catastrophic events actually happen.
Exactly. And that's why understanding cat bond performance, especially this idea of price adequacy, is so important. If these bonds are priced fairly, they can attract investors seeking those uncorrelated returns, which then provides more capital to help communities prepare for and recover from those disasters.
It creates this ripple effect where a well-functioning cat bond market can actually contribute to greater resilience in the face of these events.
Precisely. It's a fascinating intersection of finance and societal impact.
You know, this whole conversation has me thinking about what it really takes to be a savvy cat bond investor.
Hmm.
It's clearly more than just looking at past returns or relying on those pricing models.
You're absolutely right. It requires a deeper level of understanding. And that brings us to what I think is the most important part of our deep dive today. Those core quality metrics that really underpin the cat bond market.
Okay, I'm intrigued. Let's get into those nitty-gritty details. What kind of metrics are we talking about?
Think about things like expected loss profiles. It's not just about looking at the average expected loss, it's about understanding the shape of that loss distribution. Some cat bonds might be structured to cover only those most extreme events, while others might attach at lower loss levels.
So it's about understanding not just the likelihood of a disaster, but also the potential severity of its impact.
Exactly. And this leads us to another critical metric, trigger types.
Ah, yes. The mechanisms that determine when a cat bond actually pays out. And there are a few different types, right?
There are. You've got indemnity triggers, which are based on the actual losses incurred by the sponsor. Then you have parametric triggers, which are tied to a specific parameter like wind speed or earthquake magnitude. And there are also hybrid triggers, which combine elements both.
So it's like having different levels of sensitivity to those trigger events.
That's a good way to think about it. And the choice of trigger type can have a significant impact on a cat bond's risk profile and ultimately its price.
It's amazing how much complexity there is when you really start peeling back the layers. We started with those three legs of returns: price, collateral, and the spread. Then we explored that spring surprise and how it impacted price adequacy. Now we're going even deeper into these core metrics like those loss profiles and trigger types. It's given me a much richer understanding of the cat bond market.
It's a fascinating market, isn't it? And as we've discussed, understanding these nuances is key to making informed decisions. Whether you're an investor, an insurer, or even a government entity, thinking about using cat bonds for risk transfer.
Thinking back to springing ahead and all that uncertainty surrounding those pricing models, it makes you realize that cat bond investing requires more than just crunching numbers.
It does. It requires a deep understanding of those underlying risks, the forces driving market sentiment, and a willingness to constantly learn and adapt. This market is always evolving.
It sounds like you need to be both a data whiz and a bit of a psychologist to really excel in this space.
You could say that it's a unique blend of analytical skills and an understanding of human behavior.
Well, this has been a truly eye-opening deep dive into the world of cat bonds. I feel like I've learned so much, and I'm sure our listeners have too. Thanks for walking us through all this.
It's been my pleasure. Cat bonds are definitely a fascinating corner of the financial world.
And on that note, we'll wrap up our deep dive here. Thanks for joining us for